Welcome to Stock Market Math. My name is Paul, and today we're going to continue our series in fundamental investing terms and definitions. The first topic we're going to cover is shares and stocks. We'll discuss their similarities and how they're related to each other. Then we'll move on to exchange-traded funds, and we'll finish off with market capitalization. So if this is interesting to you, hit that thumbs up and subscribe for more. Let's get started. When most of us think of the term share and stock, we think of them as interchangeable. In fact, the definitions are very similar, however, they're not quite the same. Let's start off by defining share. A share represents partial ownership of a company. When a company is first started, it is owned by the person or people who start the company. As the company gets larger, the owner or owners may choose to take the company public by offering an initial public offering, abbreviated IPO. By offering an IPO, the owners give up full ownership in exchange for an influx of cash that they can use to expand the company or do whatever they deem fit. The ownership of this public company is divided into typically between tens of thousands and tens of millions of small pieces called shares. There are two types of shares, common and preferred. We're going to skip over what the difference is, and for the rest of the video, when I refer to a share, I'm referring to a common share. Owning shares of a company gives you the following benefits: the right to vote on certain company policies and changes, the potential for stock appreciation, meaning that you might be able to sell the stock later at a higher price, and dividends if the company pays dividends. Now let's talk about what a stock is. You can think of stock as a more generic term. It refers to the accumulation of all shares of a specific type. I think a few examples might be helpful. Let's say I start a company called Stock Market Maps, where I sell vintage paper maps of key locations related to the stock market. Now business is booming, and I have a large staff and I make a significant amount of money. As a CEO, I decide it's time to take our product into the Canadian market. In order to raise the large amount of capital, I decide to take Stock Market Maps public on the New York Stock Exchange. My IPO is 1 million shares selling for $10 each. Now the following statements could be said. Stock Market Maps has stock on the New York Stock Exchange. As an investor, you can purchase 10 shares of Stock Market Maps. Let's do another example. Suppose I'm talking to my brother and I ask him, is your brokerage account balanced? He might reply with something like, yes, I have 50% stock and 50% bonds. Or he might say, no, I have invested heavily in Rumble. I own 50 shares. Both statements could be true. Moving on to our next topic. Exchange Traded Fund, which is commonly abbreviated ETF. Investopedia has a good definition, which I've included on the screen. However, it is a bit complicated, so let me try and simplify. Feel free to pause the video, and you can read it if you like. Otherwise, let's move on. An ETF is created when an investor or group of investors create a fund used to buy shares in different companies. These companies typically have one or more characteristics in common. For example, companies in a particular sector, such as the VDE Vanguard Energy Index ETF, or companies that pay a large dividend, such as DVY, the iShares Select Dividend ETF, or possibly companies that produce clean energy, such as the PBD Invesco Global Clean Energy ETF. Other ETFs may pick companies in order to match a specific index, such as the S&P 500, for example, VOO, the Vanguard S&P 500 ETF, or the NASDAQ 100, for example, the QQQ Invesco QQQ Trust ETF. That's a mouthful. Now that we have a better understanding of what an ETF is, let's talk about some of the benefits and some of the drawbacks. Diversification. Most ETFs composed of between a few companies all the way up to a total world ETF. This diversification reduces the volatility of your profile. In layman's terms, you're trading the potential of picking one stock that will make you rich for the security of knowing that your investment is likely to do well in the long term. In other words, an ETF is not likely to double in value over a year, However, it is also not likely to have its value cut in half. The final term we're going to discuss is market capitalization, or as it's more commonly referred to, market cap. Market capitalization is pretty straightforward, and it may not seem all that interesting. However, the value in understanding market cap is understanding its correlation with risk, which we're going to talk about in a little bit. Market cap can be thought of as the total value of a company and is calculated by multiplying the number of shares by its current share price. Another way of looking at this would be to ask yourself, how much money would I need to buy a publicly traded company? Companies can be divided into three broad categories. Small caps are companies with a market capitalization of more than $200 million, but less than $2 billion. I've included a couple of examples on your screen, and you'll notice that these are not companies that you may have ever heard of, and certainly not part of your daily life. Mid-caps are companies with a market capitalization of greater than $2 billion, but less than $10 billion. A couple of examples will point out that these are companies that you probably have heard of, but don't use on a daily basis. Moving on to our last category, large cap. Large cap companies are companies with a market capitalization of greater than $10 billion. A few examples are listed on your screen, and the thing that you'll notice is that these companies are part of our daily life, and even if we don't use their product or service, we're familiar with who they are and what they do. I've included for your reference a spreadsheet summarizing what we've just talked about. However, let's move on to what makes market cap valuable, and that is its relationship to risk. As a general rule, the larger a company's market cap, the lower the risk of losing a large amount of money. Let me say that again. As a general rule, the larger a company's market cap, the lower the risk of losing large amounts of money. The flip to that statement is also true. Companies with a large market cap are not as likely to shoot up in price overnight. Let's borrow an analogy from physics. We know that momentum is equal to mass times velocity. If we think of a company's market cap as its mass and its earnings as its velocity, then we can draw the following conclusion. Company A, whose market cap and earnings grow over time, is less susceptible to market volatility than Company B, whose earnings and market cap decrease over time. Another example. If you had the opportunity to go with a friend to the North Georgia mountains and go off-roading, would you go in a Jeep Wrangler or a Nissan Pathfinder? One of these two vehicles has a long history of innovation and excellence in design, and the other one looks like an off-roader but is really more suited to driving to the mall. In a similar vein, it seems more prudent to me to invest in a company with a proven track record of innovation, growth, and quality management when compared to a smaller company that has yet to establish itself. Personally, I invest a majority of my money in companies that I have a high degree of confidence in and have a proven track record of long-term growth. Thank you for watching today's video. I hope you found it entertaining and informative. I hope you have a great day, and remember, keep investing.